Investors are becoming increasingly concerned about AI stocks and worried about an AI stock bubble. Companies like Nebius Group have seen their share prices fall significantly in the previous month. Nebius Group stock is down over 25%, CoreWeave stock is down roughly 50%, and others in the category are experiencing big drawdowns. And so I wanted to provide more insights surrounding this investment and Nebius Group specifically and what's going on, what's the latest development, so you can make a more informed decision rather than panicking about the loss of market value surrounding these investments.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So, in its most recently completed quarter, the company's management team said that demand was very strong. We sold out of all of our available capacity. We continue to see this as a consistent trend. And I saw the same thing when I shared with you the most recent quarterly performance from CoreWeave, which also said that demand exceeded supply. And then when I evaluated iron, of course, their demand significantly exceeded supply. So you have a situation where nearly every company in this industry is telling investors that demand exceeds supply, which is a very favorable situation for investors because that allows companies to make a choice, either increase supply to generate more revenue, or when you have a situation where demand exceeds supply, it gives you pricing power. You can increase prices, and even if a few of your customers cancel orders, you have enough replacement demand to fulfill your capacity. So you can still operate by selling all of your product, but just selling it at a higher price to generate better profits, or you can make the choice to increase capacity to meet that greater demand. It's a very attractive situation to be in. The management team saying, every time we bring new supply online, we sell all of it. Right? That's a great position to be in. It's like you have demand and you have supply, and then you increase your supply, and then you increase your supply even above demand, and then demand just goes up and buys up all of that supply. It's a great situation. And the management team says that with the new generation of NVIDIA Blackwell coming online, which is NVIDIA's latest generation, more customers are interested in purchasing capacity in advance and securing it for longer period of time. And so that's also a great announcement there is not only are they selling out of existing capacity, but they're selling out of future quarters and future years. These are longer term contracts. When Nebius Group is signing a deal with the customer, they're usually not signing a deal for 1 week or 1 month. It's usually several quarters and oftentimes several years of capacity that's being purchased. So in when they reported this quarterly earnings release and announcement, they also said that they signed a new major deal with Meta Platforms for approximately $3 billion over the next 5 years, or in other words, 600 million per year. So that was on top of the deal they announced with Microsoft in early September with the value between 17.4 billion and 19.4 billion dollars. So these are large hyperscalers that are making large commitments to purchase this computing power. And of course, the risk is still there for companies like Nebius that when these deals run out, for instance, that deal with Meta Platforms, 3 billion over 5 years, there's a risk that at the end of those 5 years, Meta doesn't renew that contract. But Nebius Group is building capacity to serve Meta Platforms at this level. And then at the end of that 5 year term, if Meta doesn't renew, then there's a risk that Nebius has that capacity that was made available for Meta that they're unable to sell to somebody else. That's the risk. Now, I think that risk is being over valued right now, meaning that investors are overly concerned about that risk about 5 years later or several years later that there's excess capacity. because I think there's going to be new catalysts that will absorb that capacity if companies like Meta don't purchase that. And one of those categories I'm bullish about is the robotics industry, driverless car technology, etc., that will grow to absorb, or you could think of it as physical artificial intelligence rather than digital artificial intelligence, which I think is going to be huge because it increases worker productivity in categories like coding and customer service, which I think is going to persist for several years, if not several decades, the increase in productivity in those categories. And then real world artificial intelligence is only just getting started with robotics and driverless car technology in manufacturing, in warehousing, in logistics, and delivering that artificial intelligence to real world applications that improves productivity and enhances profitability for several businesses operating in these categories. And so I'm not as concerned as most stock market investors are about the overbuilding of artificial intelligence. And usually I've been concerned with businesses that are investing aggressively in capital expenditure, that they're overdoing it. And I've highlighted this with electric vehicle companies. I was one of the first and only investors, especially on YouTube. You've seen mostly cheerleaders about electric vehicles on YouTube. Nearly everyone and their cousin is a bull on Tesla stock, but I've been warning about overvaluation with Tesla stock since the peak around 2020, 2021. And you've seen many EV companies go bankrupt. That's an industry where I was really concerned, like, hey, these companies are spending billions of dollars building these manufacturing facilities for electric vehicles, and I'm not seeing the benefits of those investments. I'm not seeing the fundamental organic demand for these categories. Like, these electric vehicles are more expensive than the internal combustion engine vehicles, and they're also more inconvenient. So I didn't see a reason for these investments other than if the governments around the world are going to force people and business into adopting electric vehicles. That was really the only justification, is if governments force people and business to switch to electric vehicles. Because organically speaking, if you just compare the technologies, and the consumer viewpoint, the customer value proposition, it doesn't make sense for electric vehicles. For 9 out of 10 people, it doesn't make sense. For 1 out of 10 people, it makes sense. The economics make sense, but for the other 9 out of 10, it doesn't. But that's not the case with AI and AI investments. It's the opposite. For 9 out of 10 businesses, it makes sense. And for only 1 out of 10 businesses, it doesn't make sense to invest in this technology. So I think in the near term, there will be volatility surrounding these companies. But for Nebius Group, for example, I've incorporated the added risk into the stock by increasing the beta by 15%, which increases the weighted average cost of capital, which decreased the intrinsic value per share to $110 compared to the current market price of $85. But I still see this stock as a investment with a high return potential, but it also comes with a great deal of risk. It's on the riskiest side of the investing spectrum. So it should only be considered for those investors that are okay with extremely high risk, but with the potential of extremely high return. Now, this $109 intrinsic value is just what I believe these shares are worth today. But 10 years from now, I think these shares could be worth a lot more as this company continues to expand capacity and as the world starts to incorporate artificial intelligence and we start to see the real world benefits and go beyond the concerns, then a company like Nebius Group could deliver huge returns, but it can also be something that goes down in value significantly. As we've seen just in the last month, it's down 25%. Hey, if you value my process for researching stocks, I think you'll appreciate access to my spreadsheet containing my discounted cash flow valuations, which calculate a fair value for over 200 companies. It answers the question, what's a good price to pay for a certain stock? You can get access by joining our channel at the investor tier or above. See the link in the description or click the join button below to learn more.